Trends in Counterparty Risk Management Workflows. In this presentation, we'll explore the challenges and trends in counterparty risk management by tracing typical workflows within a global bank before and after CVA desks, and how increased clearing affects these workflows. CVA pricing and counterparty risk management workflows require extensive amounts of data, as well as scalable high-performance technology infrastructure. We'll take a look at some of these challenges too. First, we'll review counterparty credit risk pricing and post-trade risk management before the advent of CVA desks. We'll look at the workflow in the case where a corporate end user hedges a business risk through a derivative transaction. We'll trace the life cycle of the trade within the bank providing the hedge from pre-deal pricing to internal risk management and regulatory reporting. The business risk may be related to interest rates, foreign exchange, commodities, equities, or even credit. For example, the corporate treasurer may want to hedge receivables in a foreign currency or lock in the forward price of a commodity. Another common transaction is an interest rate swap used to convert fixed-rate bonds issued by the corporation into floaters in order to mitigate interest rate risk. In any of these cases, the corporate treasurer explains the hedging objective to the bank's derivatives salesperson, who structures an appropriate transaction. The salesperson requests a price for the transaction from the relevant trading desk, which provides a competitive market price with credit and capital add-ons to cover the risk of losses due to deterioration in the credit quality of the counterparty or actual default. The trader on the desk works with the risk control group, which checks exposure limits with that particular counterparty and either provides the credit and capital charges directly or the tools to allow the trader to calculate them. The credit and capital charges are based on an internal qualitative and quantitative assessment of the credit quality of the counterparty. The credit portion of the charge is for the expected loss, i.e. the cost of doing business. It is analogous to CVA, or credit value adjustment, except that the CVA is based on market-implied inputs like credit spreads instead of historical loss norms and qualitative analysis. The capital portion is for the unexpected loss. This is also referred to as economic capital, which may also be based on market-implied inputs. These charges go into a reserve fund used to reimburse trading desks for counterparty credit losses and generally ensure the solvency of the bank. The Risk Control Group provides exposure reports and required capital metrics to the bank's regulator, which approves the capital calculation methodology, audits the bank's risk management processes, and monitors its ongoing exposure according to the Basel guidelines. While counterparty risk is managed through credit and capital reserves, the market risk of the transaction is fully hedged by the desk on exchanges or with other dealers. If the transaction is uncollateralized, the bank's treasury provides funding for what is effectively a loan to the customer in the form of a derivative line of credit. Some portion of the exposure may also be collateralized, in which case additional operational workflows around collateral management enter the picture. One of the drivers for CVA desks was the need to reduce credit risk, i.e. free capacity and release reserves, so banks could do more business. In the late 90s and early 2000s, in the wake of the Asian financial crisis, banks found themselves near capacity and were looking for ways to lay off counterparty risk. Some banks attempted to securitize it, as in JP Morgan's Bistro transaction. Another approach was to hedge counterparty risk using the relatively new CDS market. The new international and U.S. accounting rules mandating the inclusion of CVA in the mark-to-market valuations of derivative positions provided additional impetus for more precisely quantifying counterparty risk. Some banks attempted to actively manage counterparty risk like market risk, hedging all the underlying risk factors of the CVA. Given the complexity of CVA pricing and hedging, these responsibilities have increasingly been consolidated within specialized CVA desks. Now, with the increased capital charges for counterparty risk under Basel III and the new CVA VaR charge, there is even more incentive to implement CVA desks. With the CVA desk, most of the workflow is the same, except the CVA desk is inserted between the derivatives trading desk and the risk control group. Instead of going to the risk control group for the credit and capital charges, the derivatives desk requests a marginal CVA price from the CVA desk, which basically amounts to the CVA desk selling credit protection on that counterparty to the derivatives desk. This is an internal transaction between the two desks, which may be in the form of a contingent credit default swap, or CCDS. The CVA charge is then passed on to the external customer by adding a spread to the received leg of the trade. Note that since credit risk spans multiple asset classes, the CBA desk may deal with multiple internal trading desks. The Risk Control Group treats the CBA desk like all other trading desks, imposing trading limits and monitoring market risks using traditional sensitivity metrics and VAR. Since the CBA desk is a trading desk, it executes hedges on exchanges or with other dealers and relies on the bank's internal treasury to fund positions. To the extent the CBA desk attempts to fully hedge its CBA positions, while the derivatives desk also hedges its underlying positions, there may be some inefficiencies due to overlapping hedges. The main difference from the pre-CBA desk workflow is that the CBA desk attempts to quantify and manage counterparty risk like other market risks, instead of relying purely on reserves. It is worth noting that not all CBA risk can be hedged due to insufficient liquidity or other reasons, so some reserve-based risk management is inevitable. The main problems with CBA desks are that they insert another layer into the workflow and add substantial analytical complexity. CBA models have to incorporate all the risk factors of the underlying derivative plus the counterparty risk. Even the CBA on a plain vanilla FX forward is complex because the counterparty effectively holds an American-style option to default. In addition to the option risk profile, the CBA trader must also consider the correlation between the counterparty's default probability and the underlying exposure, or wrong-way risk. Margining formulas are much simpler than CBA and economic capital models, and new regulations are either mandating or heavily incentivizing banks to clear or fully collateralize derivative transactions. In cleared transactions, the clearinghouse effectively replaces the CBA desk in the workflow. Trades are assigned or novated to the clearinghouse, which becomes the counterparty to both sides of the trade. Counterparty risk is virtually eliminated because the exposure is fully collateralized and ultimately backed by the clearinghouse and its members. Yes, there is still the risk that the clearinghouse fails, but the Risk Control Group can focus on relatively simpler issues like collateral management, liquidity, and residual market risks. Since cleared trades are fully margined or collateralized, the CBA charge is replaced by the collateral funding cost, which is typically based on an overnight rate. Clearinghouses have been moving to valuation models based on overnight or OIS discounting of cash flows. Not all trades can be cleared. Clearinghouses will only be able to handle standardized contracts, and the Dodd-Frank and EMIR regulations specifically exempt corporate end-user hedge transactions, as in our example, from mandatory clearing. It is estimated that at least a quarter of derivative transactions will remain OTC, so banks will need to maintain both CBA and clearing workflows. Implementing robust data and technology infrastructure to support the CBA and clearing workflows can be very challenging. Banks typically have separate systems for their main trading desks, roughly aligned by major asset classes: interest rates and FX, credit, commodities, and equities. Since counterparty risk spans all asset classes, the counterparty risk system needs to extract transactions, market data, and reference data from all the various trading systems. These systems may have different data formats, symbology, and naming conventions, as well as API idiosyncrasies. All of these problems need to be solved in order to provide a reliable data feed to the counterparty risk system. Once the data feeds are in place, the feed must facilitate regular updates and data integrity checks. The next set of challenges has to do with performance and scalability. The simulation engine may have to value on the order of 1 million transactions over 50 future dates and several thousand market scenarios. Depending on the size of the portfolio and number of risk factors, some shortcuts on the modeling side may be necessary. In addition to data extracted from trading systems, the counterparty risk system requires reference data on legal entities and master agreements, which contain netting and collateral specifications. Outputs of the counterparty risk system include current, expected, and potential future exposures, CVA, and economic capital by counterparty. The system should also capture counterparty exposure limits and highlight breaches. Given the complexity of the inputs and outputs, a robust reporting system is critical. The system should allow aggregation of exposure metrics along a variety of dimensions, including industry and legal jurisdiction. The system should also allow drilling down into results by counterparty netting set and individual transactions. By extension, users should have an efficient means to diagnose unexpected results. If the bank is a CBA desk, there may also be a separate system for marginal pricing of new trades and active management of CBA. The marginal pricing tool needs to access results of the portfolio simulation, since the price of each new trade is a function of the aggregate exposure with that counterparty. Calculating a marginal CVA in a reasonable time frame can be a significant challenge. The CVA risk management system provides CVA sensitivities for hedging purposes. Notice that hedges booked by the CVA desk should also flow through the simulation engine so that they are reflected in the exposure and capital metrics. If the bank clears some of the transactions, they must be fed to the clearinghouse's systems and trade repositories. Since clearing involves daily or more frequent margining, the bank's collateral management system should be integrated with the clearinghouse. Ideally, the simulation engine would upload current collateral positions and revalue them for each market scenario to determine net exposure. The simulation engine not only provides internal risk management metrics, but also regulatory capital calculations and other information required by the bank's regulator, such as backtesting and stress testing results. So we conclude with a very complex picture. The most sophisticated global banks have targeted the CVA and clearing workflows and corresponding technology infrastructure outlined in this presentation. It is expected that regional banks will follow suit over the next few years in order to manage risk more effectively and comply with new regulations.